October 23, 2026, a date that will go down in economic history. The United States Department of the Treasury released new figures. The gross national debt has just surpassed $38.09 trillion, the highest debt load in the history of this nation. Picture it, a weight so vast that every working American, every retiree, every 401k, every family saving for a house is forced to carry a share. That burden is real. It is now buried deep in the ledger of the United States. But this isn't just a number. This is a ticking time bomb. A debt mountain rising so rapidly it threatens to shatter decades of hardness built into pensions, savings, housing, and the dollar itself. Today, I'm going to show you the hidden pattern behind this explosion, a recurring cycle of debt buildup and collapse that has played out many times before and now threatens your financial future. This is the story of the debt supercycle, and we are living through its most dangerous peak. The concept of a debt supercycle describes a long-term historical pattern, decades of aggressive borrowing, spending, and credit expansion, followed by an inevitable correction, collapse, inflation, defaults, or currency devaluation. The United States hasn't always run a debt this gargantuan. In the early 1990s, total national debt was measured in trillions, not tens of trillions. The explosion began slowly, then accelerated. In the last 10 years alone, U.S. debt has surged from roughly $22.7 trillion in 2019 to over $38 trillion by late 2025, a near doubling in under a decade. The current pace is perhaps the fastest in peacetime. According to the latest monthly update from the Joint Economic Committee, the debt rose by $2.18 trillion in a single year, adding approximately $5.97 billion every day, $248 million every hour, or about $60,000 every second. If that isn't alarming enough, as of 2025, average debt per American household has soared past $288,000. This kind of runaway accumulation is not sustainable. History shows us that when debt reaches an extreme peak, the consequences bite back. Inflation surges, currency value erodes, interest costs skyrocket, markets crash, and retirement nest eggs shrink. But few of us are connecting the dots. Few realize how far off the rails debt has gone and how fast we're hurtling toward collapse. So here's the question no one is asking out loud. If $38 trillion is just the start, how far will it go before the whole structure breaks? Stay with me, because what comes next will show you the most chilling chapter of America's financial cycle, and what it could mean for your 401k, your savings, maybe even your ability to afford a home. If you want to stay one step ahead of the collapse, hit subscribe, turn on notifications, because in this channel, we don't sugarcoat. We reveal what the data doesn't want you to ignore. The pattern begins not with a crash, but with silence. After a sweeping debt blow-off, the first phase is often a quiet reset, where the crisis fades from memory and rebuilding begins. Yet that calm lays the foundation for the next disaster. Let's rewind history to the aftermath of World War II. By 1946, U.S. federal debt had surged to roughly 122% of GDP, a peacetime high. But what followed was not collapse. It was an economic boom. From 1946 through 1960, nominal GDP nearly doubled, real output grew at roughly 2.6% per year, and rising prices helped reduce the debt-to-GDP ratio to about 46% by 1960. This is cycle one, the reset and expansion. Debt stayed, but growth outpaced it. Confidence returned. Factories opened, employment soared, the middle class expanded. For decades, many Americans had no immediate fear of government debt. That period of stability lasted until the next phase, cycle two, speculation and euphoria. With low perceived risk, credit expanded, asset prices inflated, and borrowing accelerated. Fast forward to recent decades. After the 2008 financial crisis, and especially after the pandemic stimulus, the U.S. money supply, as measured by M2 money supply, has exploded. As of October 2025, M2 stands near $22.3 trillion, a record high. That flood of liquidity fuels speculation in stocks, real estate, corporate debt. Corporations loaded up on bonds, investors chased yield, real estate prices surged. The illusion of endless growth returns. But speculation eventually brings distortions. Valuations detach from fundamentals. Risk is ignored. That leads us to cycle 3, the peak and warning signs. One of the most reliable warning signs today: the yield curve has inverted. The spread between short-term and long-term treasuries, usually upward sloping, flipped in July 2022 when short-term yields rose above longer-term ones. Historically, every U.S. recession since the 1950s was preceded by such an inversion, typically followed 10–18 months later by contraction. The danger now, despite apparent stability, strong employment, resilient markets, the bond market is signaling something far darker brewing beneath the surface. In short, we are past the expansion, we are deep into speculative euphoria, and the warning lights are on. So here's the chilling question you need to ask: when the next phase hits, the collapse, will you be ready? The calm after the boom is the quiet before the collapse. What feels like stability today, strong markets, rising home prices, booming stock portfolios, is often just the mask hiding the start of the final act. The system doesn't break all at once. It unravels slowly, invisibly, until liquidity vanishes, and that's when the real collapse begins. This is cycle 4, system breakdown, liquidity crunch, and institutional stress. In March 2020, the global economy froze. Investors panicked, pulling money out not only of banks, but from money market funds and bond mutual funds. In mere days, prime money market funds faced massive runs. Redemptions surged, liquidity evaporated, and funds that promised instant access began teetering on collapse. Many open-ended funds were forced to scramble for cash. Some contemplated suspending withdrawals. That panic exposed a critical truth. Even supposedly safe financial instruments, money market funds, mutual funds, bond funds, rely on liquidity. When thousands try to exit at once, the system jams. Regulators must intervene. The short-term funding markets, the plumbing of the entire economy, seize up, credit dries, banks tighten lending, and businesses, homeowners, and retirees feel the squeeze. Then came 2023, a modern shock. The collapse of Silicon Valley Bank, SVB, a stark example of how fragile our banking system became under the weight of this debt supercycle. In just 2 days, depositors rushed to withdraw funds. SVB had invested heavily in long-term securities. When interest rates spiked, those securities lost value. Withdrawals snowballed. On March 10, regulators seized the bank. SVB's downfall was not about a bad business model. It was about a fragile system stretched too far, a system built on debt, inflated asset values, and illusions of liquidity, all at the peak of the supercycle. But that leads to cycle 5 and 6, panic, margin calls, and modern investor traps. When liquidity dries up, when banks fail or funds freeze withdrawals, the panic spreads. Investors rush for safety. But unlike in 1929, many Americans today don't hold cash under the mattress. Their life savings are trapped in 401(k)s, mutual funds, ETFs, retirement accounts, bond funds. Suppose you want to liquidate your 401(k) or brokerage account when the panic hits. It isn't simple. Early withdrawals from a 401(k) before age 59 typically trigger a 10% penalty on top of taxes. Or imagine you hold mutual funds or bond funds that suddenly face redemption pressure. In 2008, one of the most infamous cases was Reserve Primary Fund. When its underlying assets cratered, it broke the buck. Its net asset value dropped below $1, and the fund froze redemptions. Investors couldn't get their money out immediately. The same mechanics apply today. Funds under stress can impose gates, suspend withdrawals, or severely delay redemptions, leaving investors stuck while markets crash around them. That means your retirement nest egg, your long-term savings, your 401(k) or mutual fund holdings, they may not be accessible when you need them most. And then comes cycle 7, collapse confirmation, system reset, or currency breakdown. At that point, debt-to-GDP ratios, interest servicing costs, unfunded liabilities, currency devaluation, all converge. The system can no longer carry its load. Something must give, either a restructuring, debt default, haircut, inflation, or a complete financial reset. And we are not far from that juncture. The debt burden of $38 trillion rests on an economy already weighed down by elevated interest rates, soaring obligations, and fragile liquidity. When this final collapse triggers, it won't just be a stock market crash. It won't just be a housing slump. It will be a systemic purge. 401(k)s locked, mutual fund redemptions frozen, banks swallowed, currencies devalued, wealth vaporized. This is not theory. This is history repeating, but with a new level of sophistication. Modern financial instruments add layers of complexity and new traps, and you may not know the danger until it's too late. And now the question looms. When the collapse comes, will you still own your savings, or will the system own you? Yes, the traps are set. Your 401(k) brokerage accounts and even cash in the bank could be frozen, delayed, or devalued when the next phase hits. But history provides a roadmap, a set of strategies proven over centuries to preserve wealth through financial collapse. The first principle is simple: preservation of capital over profit. In moments like these, protecting what you already have matters more than chasing returns. The patterns we've seen, the post-WWAI debt reduction, the 1929 crash, the 2008 liquidity crisis, all point to the same lesson. Survival depends on tangible, liquid, outside-the-system assets. That brings us to 3 historically validated hedges. Hedge 1, physical gold. Gold has survived every fiat currency collapse in modern history. During the 1933 U.S. gold confiscation, Americans who held private gold outside government reach preserved real wealth. After the confiscation, those who retained physical gold in safe locations, hidden in vaults or overseas, maintained purchasing power when the dollar's real value contracted. Today, holding gold outside your brokerage or 401(k) in private vaults, allocated bullion accounts, or physical bars at home or in secure storage acts as insurance against frozen accounts or fiat devaluation. It is not speculation, it is survival. Hedge 2, land or tangible property. Real estate, farmland, or property with intrinsic utility has historically preserved wealth through economic collapse. In post-World War II Germany, individuals who invested in land or agricultural property retained real value even as currency depreciated drastically. Today, property with cash flow potential, rental income, agricultural use, or strategic urban location offers protection. Unlike digital stocks or ETFs, physical property cannot be frozen by a brokerage system. It provides both a store of value and a potential income stream during systemic disruption. Hedge 3, cash outside the system. This may sound counterintuitive in a digital age, but history proves it effective. During the 2008 global financial crisis, banks faced liquidity shortages, and some accounts experienced delayed access to funds. Those with emergency reserves outside the traditional banking system, in foreign accounts, multi-bank strategies, or even secure physical cash, could operate when others could not. The key is controlled exposure. Enough liquidity to cover essential needs during a freeze, while avoiding risk inside the trapped system. Diversifying location, ownership, and format of cash is essential. Don't rely on a single institution or digital platform. These 3 hedges, gold, land, cash outside the system, form a simple, historically proven triad. They are not about speculative gains, they are about survival. When the next cycle completes, they will be the difference between solvency and loss, between agency and helplessness. But even with these hedges, awareness is vital. Understanding the supercycle, the warning signs, and the traps allows you to act before the collapse hits full force. Timing matters. Preparation matters. History rewards those who anticipate, not those who react. And now the final warning. The $38 trillion debt bomb is ticking. Every delayed policy, every ignored warning Every assumption that it won't happen to me accelerates risk. The system is fragile, layered with digital traps and liquidity illusions. Only those who act decisively, who follow these historical strategies, will preserve their wealth. The traps are locking. Only those who act on this knowledge will survive this cycle. If you found this video valuable, subscribe now. Turn on notifications, because the next phase is already underway and missing updates could be costly. And let us know in the comments, what crisis or financial pattern do you want us to analyze next? Your question could guide our next investigation into the hidden cycles shaping the US economy and your wealth. Remember, knowledge is not just power. In this cycle, it is protection. Prepare wisely, preserve your capital. History favors the informed, and this cycle will reward only those who understand it before it strikes.